take profits in gold and silver and all the rest of it. I think I can understand people needing liquidity because their budgets are probably being squeezed in this current situation. But my advice is always the same: get the hell out of credit. And if you're getting out of credit, where do you go? Well, there's only one place to go, and that is real money, which is gold. To a lesser extent, silver. I don't think silver will ever really come back as official money, if you like. But, there is no doubt about it that there is a very large portion of the global population that still regards it as money. And at the moment, that price is being driven entirely by this squeeze from industrial demand, while at the same time, China is reducing her supplies into the West.
In today's news recap, Americans barely own gold. That means prices could climb even further, Goldman says. Gold's record rally this year has grabbed headlines, but American investors barely own any of it, which means the yellow metal's price could have more room to run, according to Goldman Sachs. Even with gold hitting repeated highs, U.S. ownership hasn't budged much. Gold ETF exposure is still 6 basis points or 0.06 percentage points below its 2012 peak since the launch of gold ETFs in the mid-2000s. According to Goldman's analysis published on Wednesday, the low gold allocation is simply because portfolio growth has outpaced gains in gold prices and volumes over the past decade, Goldman's analysts wrote. And while gold has surged to new all-time highs in 2025, Goldman's analysis shows that the rally hasn't translated into meaningful increases in actual U.S. ownership. Gold ETFs make up just 0.17% of private U.S. financial portfolios as of the second quarter, a microscopic slice of the roughly $112 trillion Americans hold in stocks and bonds, according to Goldman's analysis. Goldman's data also shows that fewer than half of large U.S. institutions managing over $100 million hold any gold ETF position at all. Among those that do, allocations typically sit between 0.1% and 0.5%. For major long-term investors, only about 0.2% of their portfolios are in gold. Despite the social media buzz around Costco gold bars and U.S. mint coin sales, the report notes that physical gold demand in the U.S. is tiny compared with ETF flows, just 11 to 15 metric tons year to date versus roughly 400 tons of net ETF buying. That low ownership stands in sharp contrast to recommendations coming from major market voices, including Citi, UBS, Morgan Stanley, BlackRock, and Bridgewater founder Ray Dalio, advising investors to add gold to their portfolios. The gap between those recommendations and reality is exactly what Goldman says could push gold's next leg higher. Now smash the subscribe button, turn on notifications so you do not miss out our daily recaps, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio so you do not have to rely on market commentators to stack efficiently. Let's get back into the episode.
Is that it's not just a question of the expansion of the quantity of credit in the economy that undermines its value. It's also the faith that the users have in that credit. Now, I don't see the average American getting terribly worried about that. I mean, he'll see his, price of gas, as they call it, petrol going up. He'll see price of food going up and all the rest of it. He's already seeing that, actually. He'll see that accelerating. And he'll blame it on, greedy capitalists, whatever, not money supply. But when it comes to the faith, that is a far bigger factor. And bear in mind that foreigners, according to the US Treasury tick figures, they have a total of over $44 trillion of dollars and underlying dollar financial investments. 44 trillion. Bear in mind that US GDP is in the order of about 30 trillion. This is just absolutely enormous. The amount in equities is 20 trillion, over 20 trillion, in fact. So when that bubble pops, what do foreigners do? They do what they've always done in the past. They try and get the hell out. Now, they won't realize 20 trillion, that's for sure. They'll probably end up getting out and only getting out something like 9 trillion. But you can see that there's going to be massive selling of the dollar in the foreign exchanges under those circumstances. And it's all part of the unwinding, if you like, of carry trades and all the rest of it. All this sort of stuff is coming to a head. It's dramatic. It really is dramatic. And, this is sort of partly my mission, if you like, current mission, to try and sort of get people to understand this. I doubt we'll get the political class to understand it because their terms of reference are what their electorate wants. Their electorate is just totally ignorant of these facts. And they're all chasing, we want the government to give us more money. They're all in that mode. And that's not going to change. That is not going to change at all. So politicians just ignore all this at all. I can tell you, underneath it, we are living in extremely dangerous times. And the ending of the fiat currency system, it basically threatens to wipe out the value, all the value of these paper currencies, unless a government gets itself into the sort of position where it can actually deal with it, balance its budgets, produce a surplus on its budget, so get the country out of the debt trap, which is rapidly coming upon them now, and adjust economic policies so that they can actually sustain a relationship between their paper currency and gold. Otherwise, there's no knowing where this stops. I mean, in the case of the Reichsmark, in 1913, there were 90 Reichsmarks to an ounce of gold. At the end of it, there were nearly 100 trillion.
In today's news recap, gold eases after divided Fed rate cut vote. Silver hits new high. Gold edged lower on Thursday as traders weighed the U.S. Federal Reserve's divided vote on a 0.25 percentage point interest rate cut, while silver climbed to yet another record high. It's just an overpositioning in gold in expectation of the rate cut, which did happen, and therefore you're seeing some selling pressure, said independent analyst Ross Norman, adding that gold's fundamentals remained intact. The Fed cut interest rates by 0.25 percentage point on Wednesday in a rare divided vote, but signaled a pause on further easing as officials look ahead to assess the direction of the job market and inflation that remains somewhat elevated. Projections issued after the two-day meeting showed most policymakers see just one rate cut in 2026. Fed Chair Jerome Powell offered no indication of when another cut might occur. U.S. President Donald Trump said on Wednesday that the Fed's rate cut could have been larger. Trump is set to announce the new Fed chair early next year, with White House economic advisor Kevin Hassett being a frontrunner. Investors are now looking out for November's non-farm payrolls and unemployment rate data due on December 16th for further clues on the Fed's next move. Spot silver to $62.09 per ounce after hitting a record high of $62.88 earlier in the session, bringing its year-to-date gain to 115% on strong industrial demand, declining inventories, and its addition to the U.S. critical minerals list. Silver's fundamentals remain incredibly positive. There is a phenomenal tailwind with the critical minerals list and the possibility that we might see some stock building, which would further increase market tightness, Norman added. Now smash the subscribe button, turn on notifications so you do not miss out our daily recaps, and check goldsilverstacks.com to get the Stacker's Handbook, the ultimate guide to trade the gold-silver ratio so you do not have to rely on market commentators to stack efficiently. Let's get back into the episode.
And that is, Argentina has had decades of economic destruction, of the value of credit in their own currency, and so on and so forth. So everybody knew that something had to be done. And this is why Milei got a landslide. And, he was given a clear mandate by the people. There's no way the population in any of the European countries or America could get that sort of, would give a politician that sort of mandate. Because we haven't had the decades of complete destruction. And the situation in Argentina is the bureaucrats basically were living high on the hog while everybody else could go to hell. And it's an ongoing thing. I mean, he's also got to be careful that he doesn't lose that mandate, because what he's doing is going to be very, very tough on the, it's already very tough on the establishment, but that's going to continue to be tough, if you like, not only just on the establishment, but also around the country. And it's all very well saying, okay, we've got inflation down to 2% a month or something, whatever they've got it down to. But when you're sort of squeezing people, if you like, by taking things away from them, they start questioning, is this a good idea? It's difficult. It is, I think, a lot more difficult than people would think. You just go in there with your chainsaw and you just cut this, cut that. I mean, the currency has sort of held up, been buoyed up, if you like, by the system in a way which didn't occur in the Argentine. Sorry. So, in France, it's absolutely classic. Ordinary people go about their own business despite the government. The government, is just, quite frankly, finds that it's impossible to do anything, if you like. I mean, for a start, they haven't got a clue what they're doing economically. And secondly, they haven't got a mandate to do anything anyway. So all they do is they just jump around on the global stage, with Macron trying to sort of get together a policy on Ukraine and all the rest of it. They can't even change the pension arrangements, without farmers and all the rest of it dumping manure.
Do you agree with him? Are you still bullish in gold and silver? Is a massive collapse going to happen in 2026? Post in the comment section down below your honest opinion. Subscribe if you have not yet done so. And watch this video right here because it's a perfect fit for you. I'll see you on the other side.